Hello, everybody. Today we are going to present a webinar on selling your business and what you need to know about preparing for a M&A exit deal in the real estate technology industry. I'm joined by Ben Lerner of Lerner & Associates, financial advisory firm, and I am Blake Liggio from Goodwin Procter, global law firm located out of the Boston office. Our agenda will be, we'll provide you with an illustrative transaction timeline first and walk through the overall timing of a transaction. We'll then provide you with a current state of the real estate tech M&A industry generally. We'll go into the sell-side M&A process in particular and some specific details with respect to the legal guidance and financial advisory guidance that you receive throughout the course of the process. And then we will go into information that we would suggest that you organize and collate early on in the process to be prepared to move quickly into the deal. And finally, a little bit of preparation advice for introductory calls with potential acquirers in the pre-signing stage and what those calls look like. So with respect to illustrative transaction timeline, generally deals can span over the course of varying varying periods. For these purposes today, we've used a template timeline spanning the course of 4 months or so. We would note that in the current market environment, it's taking a little bit longer to get deals up and running. And so you see on this illustrative timeline that we have preliminary preparations spanning the course of around 30 days. That is not always typical, but right now that's what both Ben and I are seeing in the market. Part of the other ramp up action item set is engaging an M&A advisor and your legal team. And there, Ben, I would pause just to get your input of what you view as the key qualities of an investment banker particularly in prop tech industry transactions as compared to other industries generally.
Yeah, thanks for that, Blake. I'll certainly come on to that. Just by way of a quick introduction, Lerner Associates is an M&A boutique advisory focused purely on the real estate and the wider real estate tech space. So we worked closely with Goodwin and in particular with Blake on the legal side, and we've been great partners up until now. And yeah, between us, we can cover the M&A advisory side and the legal side of any transaction. As Blake says, looking at the timeline of transactions, certainly at the moment, things are slower. Not necessarily from a deals perspective in the sense that deals or let's roll back a second. Certainly from the deal perspective, people are still wanting to do deals. There's still deal flow out there, and people were still looking to buy companies. But the actual process is definitely dragging out over a period of more months than it would have taken otherwise. And we'll come on to some of that in a second when we talk about the M&A status and where things are generally in the world. But coming to Blake's point about engaging an M&A advisor and what you should look for in an M&A advisor, I think first and foremost, it's definitely worth finding an M&A advisor who has actually got experience in the space. So somebody who knows the industry, understands what your product is, where your product is placed in the industry, who the key players are in the industry, and what deals have been done in the industry. That's definitely key, rather than just finding an investment banker or an M&A advisory firm who might have done broad technology or even not necessarily broad technologies, just a general advisory firm. Finding the right people who've definitely got experience helps. And that I would say that for two reasons. First of all, there's experience in understanding who the key players are, who the potential buyers are, and who would be interested in your product and in your business. But there's also from an advisory perspective on how to run your business and how to prepare for an exit, somebody who actually understands the industry, understands your business and the area that you play in, can provide advice on how to position your business be it from a management perspective, be it from just a structure of your business. So somebody who actually understands the business and understands the industry will be able to make sure that you can command the best price for your business, and that we can present your business in the best way possible. So definitely, first and foremost, choosing an M&A advisor should never be based on price. It should be based on their ability to execute a transaction, and that's down to experience in the industry. You know, I'd say from a personal quality perspective, certainly an advisory practice or a specific advisor that actually gets on with people and is a relationship person is much more important than an advisor who just comes across, you know, from the financial perspective or from a process perspective.
Great, thanks, Ben. I agree with all of those thoughts, and your firm in particular being focused solely on the real estate technology industry, I think is a great fit for these particular transactions. Going forward on the timeline, so once the company engages its advisors, principally the M&A financial advisor and the legal team, we begin to get into document review and reviewing the business, getting ready for diligence, preparing outreach materials on the financial advisory side. From there, that process usually takes between 2 or 3 weeks, and then it can continue to be iterative throughout the course of the entire process. From there, we generally launch into the outreach that is conducted through Ben and your financial advisor. We negotiate NDAs in order to make sure that the outreach process itself and any confidential information that we exchange with buyers is confidential. NDAs can be entered into at varying stages, but they're typically entered into early on in the process. And then we engage in introductory meetings. And again, those are facilitated by the financial advisor and involve the core management team in most instances. Those meetings last between over the course of 2 or 3 weeks. But again, you can have management meetings all throughout the period up until signing in order to make sure that the parties are on the same page before they get locked into a contract. Due diligence is, and we'll get into a little bit more granularity on the due diligence process in this presentation today, but that is a process that lasts throughout the course of 2 or 3 months, depending on the period between commencing the deal and signing. It is an intense process. Getting prepared for that in any sale process is key. And it involves a lot of coordination between the company team and its advisors, both financial advisory and legal, and also informs the key provisions of the definitive agreement as well. And that process leads all the way up until the signing date itself. It's not often the case that we have post-signing due diligence, but in some deals you might have a confirmatory due diligence between signing and closing. The offer negotiation, proposals from the buyer, again, Ben and his team coordinate that piece on inbound indications of interest. We review them from a legal perspective to understand what buyers are thinking on key transaction terms. LOIs or indications of interest can come in at any time up until signing, although typically we get price locked in around, around 2 weeks prior to signing a deal at the latest. Contract markup usually comes in concurrently with the indications of interest. Usually the final indication of interest, to the extent that there's a number of proposal letters throughout the process. Drafting and negotiations of the contract, which is a key piece of the sell side process, is typically spans between 3 and 4 weeks prior to signing the deal. Final board meeting and other approvals happen on the eve of signing. In this illustrative case, we have that out in the end of September, first week in October, and then signing the definitive agreement itself happens relatively concurrently with our final approval process. And then on a post-signing basis, we have the interim period between signing and closing, which can be quick, or it can be longer to the extent we have regulatory approvals and other consent requirements in connection with the deal. Those approvals typically are initiated immediately following signing and then get completed, depending on the level of scrutiny, within 2 or 3 weeks of submission of those filings. And closing can span, between, as I said, very quickly after signing to a much more protracted period, depending on the deal type and any contingencies associated with the deal. I would say right now, and Ben should chime in here as well, that we are seeing the period between signing and closing of deals taking a little bit longer due to the current risk environment and the pandemic, as buyers are looking carefully at the performance of the business between signing and closing.
So that's an interesting point, Blake. And I think, a lot of the timelines and the timescales that we have here will depend on, obviously, COVID aside, it depends on the type of business and the size of the business and various different things. So, delays between closing and post-closing obviously depend on the kind of business and some regulatory filings and all those kind of things. But essentially, what we have over here in terms of a process is 4 or 5 key areas. You have preparing the business, and that means finding the M&A, the legal teams, and we'll come on to that in a second, but preparing the business, getting some information together. You then have outreach, and outreach is certainly throughout COVID takes a lot longer because people are busy with their day jobs. So until you actually get them hooked in and actually want to talk about a deal, just going out and finding a potential buyer takes a lot longer. But essentially, you've got the prep work, you've got the outreach work, you come to some kind of high-level agreement and an offer. You then go into due diligence with that buyer to be able to understand the business, learn the business, turn the business upside down and know everything there is about it. All that time throughout due diligence, the respective legal teams are working on the final documentation and its various iterations. Sometimes what you find in due diligence will affect the offer. Sometimes you're still stuck at the original number. Hopefully you're still at the original number and you don't have to have revised offers. But ultimately, once you get through that due diligence phase, you come out the other end with a legal sale agreement. And then at that point, you're closing and carrying out post-closing tasks. So really that process is preparing the business, outreach, finding a buyer, agreeing high level with the buyer, due diligence and legals, and then closing the transaction. But let's take it right back to that beginning stage. So in preparing the business, you asked me what people should look for in an M&A advisor. What should they look for in a legal advisor? Because listening to you, and I'm going to be flippant here, but listening to you, there's a lot of reviewing NDAs, there's a lot of preparing sales agreements, a lot of stuff that happens on every kind of deal. How important is it who you choose from a legal perspective then? And how would you choose one legal company or one legal advisor over another?
Yeah, thanks, Ben. There's always a lot of documentation in connection with these deals and a lot of process, and it's easy to get tied up in how lawyers hold up the process, and so to Ben's point, there are a lot of things that we usher throughout the course of these transactions. But similar to what you said, Ben, in selection of a financial advisor, particularly in this industry, which is relatively nascent and has its unique factors. I mean, first of all, the substantive expertise is a key piece. The target company throughout the course of the deal is going to rely heavily on its outside legal team for all of these key documentation pieces that are involved in a deal. And then for overall guidance over the course of the transaction. And we do a lot of collaboration with the financial advisor on that piece as well. So it's sort of a 3-way team.
Yeah, and I think it's not about the financials. If I can cut into you there, I think, when I talk to people about legal and what they should be choosing, I think what you don't want is somebody who just is going to do documentation for you, because there's a lot of people who can do documentation for you. I think it's that whether it's the financial side or whether it's the general commercial side, having your legal team understand the commercials and provide commercial advice as well along the way is really what's key. So again, knowing the industry or knowing the players or knowing the products and that kind of thing is definitely helpful, because you don't just want somebody who can draft documentation. You really do want somebody who can actually provide some commercial common sense almost, don't you?
Yeah, no, absolutely. I mean, great deal lawyers are advisors, they're partners in these deals, and
yeah.
Right. They need to understand the industry. They need to understand, standard leverage dynamics in the industry to really be a partner to you throughout the course of the transaction. To advise you. There's ups and downs, and as Ben said, it's really finding somebody who's commercially practical, I think, is the best quality of a deal lawyer.
Yeah. But then that kind of, people like to think that many of the delays in the deals are down to the lawyers. Then I think practicality is actually a very good word there, because sometimes there can be a lot of legal wrangling and a lot of to and fro that are hold up. So, and actually what you really want is just a commercial viewpoint that says this is what's important, this isn't what's important, and being able to kind of just make sure that process keeps on keeps on happening. Because I think everybody I speak to will always say that the legal guys are the guys who are going to hold stuff up.
Right. Yeah, I mean, we experienced deal lawyers, as I said, know the battles to pick. I mean, there are specific risk allocations that actually really matter, but for the most part, for example, reps and warranties are qualified by materiality in these deals, and so you don't want somebody who's going to get caught up in a bunch of minutia and really hold up getting the deal done, and that's never my personal intention. And great deal lawyers don't sort of interfere in that regard on the deal. I think just briefly, a couple more points. I mean, knowledge of this industry, as Ben articulated, there are particular areas of the real estate technology industry that I think are unique. There's specific dynamics and those dynamics in the industry also inform the deal terms. And so having that basis of knowledge is key, both for us and for you, Ben, as you said as well. And then also, as Ben said, just an overall fit. You want to be working with somebody who you feel like you can really form a team with over the course of the deal. And that's the case too. But, on the relationship among the advisors, Ben, as Ben said, we work together on a number of deals, and you want to have a dynamic and a flow there as well.
Yeah. Yeah.
Yeah. So with that, maybe Ben, you can take us a little bit into the current state of the market as you see it, and give people a sense of that viewpoint as well.
Or current state of the market, I should say, is it's something that people are asking about the whole time. What's the impact of COVID? Are you seeing lots of startups coming to the market because they're worried about cash, or buyers stepping back and not interested anymore? I think the good news is that there's still very much a demand from buyers, be it institutional buyers, be it from or trade industry buyers or institutional investors who like the space. There's still very much a demand for them for real estate tech businesses. And by real estate tech, I'll put into that bracket real estate tech, FM tech, data, construction tech, smart buildings tech, anything that relates to real estate and buildings. It's still very much interesting to investors, both industry, existing companies in the space, as well as general investors. So the deals there, the will is there. People want to do the deals. As we talked about earlier, the cycle of the deals, the timelines of the deals is definitely longer. Because people are just dealing with operational things. Due diligence, for example, is harder as well. Just not having access to be able to go necessarily and meet with people is harder. You have even post close, people have to think about what they're going to do with this business, how they're going to integrate this business. So all of that kind of planning and what they would do with the business on day one, especially if people working remotely, and how you onboard companies, all of that needs proper thinking about. So that's going to drag out a deal. but ultimately the will is still there for people to do deals. There's some key areas that are hotter than others. So as we think about going back to work in the post-COVID area, understanding how buildings are used, efficiencies in buildings, being able to be socially distant within buildings, and having to touch things less, so visitor management, contact-free type software or hardware, all those kind of things are definitely hotter than, say, real estate investment, which is a bit slow at the moment, or retail. Retail market is very tough at the moment. So if you can help the retail sector, great, but retail investment is tough. So, people understand what's going on in the world. The hot areas like how you manage buildings and how you use buildings and getting back to work and smart buildings, those are obviously hotter than some of the other areas. But overall, deals are still happening, and not just happening, but the multiples and the valuations around companies are still as strong as they were pre-COVID. I think longer term, it's very hard to say. I think people were anyway expecting in the next 12, 18 months some kind of lowering of activity almost, or lower multiples, purely based on the world economy and what the outlook was there. That was pre-COVID. So post-COVID, is there going to be that same uncertainty? You've got elections coming up in the US as well. All of that has an impact. So nobody can really say what's going to happen. I think people are expecting some kind of lower multiples in the next, say, 18 months or so. But certainly from a COVID perspective, going back to work, things are starting to get back to normal. I think the process, which has been slow, is going to start gathering pace, particularly after the summer break as well. So hopefully we should see that return to normal deal cycle timelines. But overall, the outlook is definitely still good for the next 18 months, in my opinion. And just in terms of what's actually out there, yes, you're seeing some of the scale-ups, thinking about getting to market earlier than they had intended, whether it's because of a cash runway or just because people tend to think about M&A, when something like COVID hits them. And from a buyer's perspective, absolutely, even those who are looking for scale will consider a product purchase if it meets their strategy as well. So, yeah, I would say the key takeaways for me are that absolutely things are still happening. There's still deals there to be done. It might be a bit slower, but people are actually taking advantage of what's out there, taking advantage of what's happening in the market, and open to all of the options.
Yeah, I agree. I mean, we're continuing to see a good amount of interest on the legal side as well for at least exploring the possibility of doing deals. One question for you, because you have a great view, I think, as you sit in these deals with advising sellers, but you have kind of a view right into the buyer process as well with the way you communicate and facilitate the deals. Are you seeing anything in particular about buyers' focus on tightening their acquisition processes and, given the current market?
So I wouldn't say that necessarily tightening or changing criteria. I think obviously there's a lot more scrutiny into making sure that the business is viable long term, and that the forecast is still going to be met to some degree, and looking what the COVID impact is. So definitely people are taking they're looking at the risk involved from a COVID perspective and how that's going to affect the business, which you'd expect. As I mentioned earlier, they're also looking at how they would onboard such a business. And onboarding during COVID with remote working, and culture is so important. So you want to onboard a new business, you want to make sure that you can access the teams, you want to bring that culture in, and it's quite hard to do, or very hard to do remotely. But people are still doing it, and they're doing it well, and they're getting their heads around it. But thinking about how they're going to do that is definitely something they're thinking about. So I wouldn't say they changed the criteria. I think if anything, they're a bit more open to options. So where people would have liked bigger businesses, they will look at a smaller business if the product is right, if the metrics are right. So I think if anything, criteria might be slightly relaxed positively. But at the same time, I think there is more risk, and people are going to do proper diligence around the COVID risks and what they perceive to be the long-term effects of COVID. That's definitely that's definitely going to impact the time. And I think simple things like being able to get in front of business owners and management teams is harder. We use Zoom, we use online tools. It's not the same as sitting around a table. So trying to get a feel for management, for the structure of the business, for how well it works, it is definitely harder to do. People definitely do spend more time in that sense. Overall, I think people are looking at this from an opportunistic perspective more than anything else, and just trying to mitigate the risks as much as possible.
Yeah, agree. I think people, it's particularly now, I think you're right that coming out of the summer months, there will be some momentum, but you see companies are starting to get past that emergency stage. I agree. I think you're absolutely right that coming out of the summer months, that we'll have some momentum here because, I think we're starting to see our clients move out of that emergency stage and really get into a place where they've stabilized the business and where they're going to start to look at opportunistic acquisitions, particularly with real estate technology. As you said, I mean, the other piece of it is that these technologies are so key to getting people back to work, which is also a huge, huge catalyst as well.
Yeah, and that had the trends that were coming through beforehand, whether it's tenant engagement, whether it's residential or commercial, those kind of things, smart buildings, just more and more efficiencies, data. Those trends are still here to stay. So there's still some nice early companies and scale ups working in that space. They're still very, very attractive. So people will make allowances for COVID, where companies might not have met their original forecasts and targets, but absolutely they'll want to dig deep and make sure that they understand the risks and they understand the impact of the longer term impact of COVID.
Yeah, definitely agree. And some of those key use cases have, I think, done a good job in this space of adapting their platforms to incorporate building wellness and health and safety and those types of things through the technology platform that they already have.
Yeah, absolutely.
Yeah. All right, so let's move into the sell side M&A process and maybe a bit of a simulation from each of our perspectives on the key periods. We've covered a little bit of this in the timeline, but we can just go through kind of key areas and talk about each of our respective roles so that we can give people a sense of what it will look like to start.
Yeah, I think the key thing on that, and we'll go through it, but the key thing on that is the beginning seems quite top heavy from the M&A advisory perspective, and then obviously once you've got a potential buyer, it's very top heavy on the legal side of things, and the M&A advisory side becomes much more facilitation and supporting and just making sure that it's all happening. So yeah, it's quite distinctly M&A focused initially, and then legal kicks in strongly. But I would certainly say either way, as we mentioned before, you want to have your legal people lined up as well as the M&A advisor, even though right at the beginning it's less of a legal workload. You still want to have them very much in the picture from day one.
Yeah, agreed. And I think you're absolutely right that right now we're in that stage of the ramp up where you're doing a lot of the work and we haven't yet moved into the negotiating the deal and the legal aspects of the transaction, getting right up to signing. So to that end, the ramp up period, I'll give my view first of our legal involvement, and we assist initially with formulating the overall strategy from a legal standpoint, and then also providing the target company team with an overall transaction timeline, and we'd also help to facilitate establishing a working group and getting these dynamics that Ben and I have been talking about up and running with third-party advisors in that period as well.
Yeah, and I think from the advisory perspective, we spend quite a bit of time understanding the business, understanding the founders, understanding what's gone on, the product, and knowing the strengths of the business and how to pitch it, and that then allows us to be able to create the right teasers, create the right documentation, the right memorandums to be able to position the business correctly to the buyers that we want to position the business to. So spending that time initially with the founders, which can take some time, but to actually understand the business properly, that then makes for a slicker process later, when early on you can actually identify your target buyers or target buyer profile, and then actually create the materials of what you see. So that bit in the early bit of really spending time with the founders and understanding the business is really key.
Yeah. And then we move into the initial buyer and seller contacts, which are, the procedure principally navigated by Ben. On the legal side, we assist with thinking about deal structuring in terms of buyer outreach and kind of giving the target company a sense of risk with respect to particular buyers and buyer profiles. The other big piece are the confidentiality agreements. So as we hand the process to Ben to start to provide teasers and other non-public confidential information, we want to make sure that that information is protected by confidentiality agreements. That's typically a very brief process, and the legal team manages it. So that's another piece of this stage. And then just thinking about overall process considerations and making sure we're executing on the overall deal timeline as well.
Yeah, and I think there's different ways that outreach process works. So some businesses are going to be looking to sell. They want to have a wide net and reach as many people as possible. And for various reasons, it's not always a secret that they want to sell. So that has a different type of outreach and a different type of timelines and timescales, where you might have a bidding process and all sorts of things. And the other side of that is where you might have people who obviously very discreetly want to go out there. They might only want to approach 2 or 3 or a handful of potential buyers. It might be a much less formal process, and might not necessarily be a bidding war. You might just reach out to one person. But so the outreach can look different, but that certainly a lot of the outreach is having or the advisor having those initial conversations with people, providing whatever information they can before NDA, during NDA, after NDA, bringing the seller into conversations at the right time to provide more context and to actually meet them. So a lot of the outreach is the advisor going backwards and forwards and talking to the potential buyers multiple times, going through documentation, answering any questions, providing follow-up documentation. That whole process takes quite a while. But ultimately, what we want to do is kind of balance the amount of time we're taking of the sellers to actually engage with the potential buyers, rather than running their business, which is always the worry, that you spend so much time on the process while you're trying to run a business, but actually involving the seller as necessary. So the idea is to get the advisor being able to handle as much as they can handle, and having the seller be involved as much as the seller should be or wants to be involved, and then getting to a point where you find a buyer or multiple buyers, depending on the process, and being able to get to a stage where you're getting some offers on the table that you can then start to work with the legal teams to put those offers into some kind of legal framework.
So with respect to this period too, I mean, another piece of it is developing a competitive tension so that you can makes your job easier to push price up, particularly on the sell side.
Yeah, and again, that depends on the process. Sometimes you want to do that, and obviously you'll always want to get the best price you can for the seller. Sometimes you might only be approaching specific people purely because it's complementary. There's all different reasons how you can approach that. But yes, obviously you want to create some kind of fear of missing out where there's multiple people involved, but where you're actually approaching just one person for some kind of a strategic acquisition, and you're only engaging with one person, you obviously want to be able to get the deal done as quickly as possible. But there's obviously it's the advisor's role to make sure they're acting in the best interest of the seller, and covering all of their objectives. Some of it might be post-sale terms, some of them might be purely on price, some of it might be there's various different elements that will be important to the seller, and it's for the advisor to achieve the best interest of the seller overall.
Yeah, absolutely. And then We'll go quickly here so we can get into some of the final topics. But pre-signing diligence, again, we've really covered that, I think, in pretty good depth. But the legal team is crucial in helping, as Ben said, providing the company team with some support externally from from having to take on this new aspect of running a deal at the same time that you're operating the business. And the diligence process is obviously a key piece to informing our development of the definitive agreement and the reps and warranties in the agreement as well.
Yeah, and let's not skirt around it. Due diligence is a brutal process. It's a lot of, it's time consuming. You're revealing a lot, you're collating a lot of information. It can take up days and days and days of work when you're trying to run a business. And then you have the added concern always about how much you're sharing. No deal's done till it's signed on a dotted line. So do you really want to be sharing? How much do you want to be sharing? So working together with legal advisors and the M&A advisors, from a perspective of let them do as much as they can do so you can run a business, but B, also taking their advice along the way as to how to present information, as to what that information looks like is going to be really key. And the reps and the warranties, all of that kind of stuff is really key. So yeah, it is definitely a tough process. Everybody wants it to last the shortest amount of time possible. I think Blake mentioned previously it could be 2 months, 3 months plus sometimes. I've seen it done much quicker, but that depends on the business and depends of getting all the stars aligned. But DD is definitely an area where you want to give as much as you can to the advisors and to the legal teams as possible, to allow you to focus on the business.
Yeah, absolutely. And then moving into the signing stage, that's another area where target companies can rely heavily on, particularly legal at that point. Ben's work is pretty much done then. The price is locked in, and we've narrowed down our bidding parties. But managing the process consideration around signing, getting all the action items done, signature pages, signing the document itself, and any board approvals and other internal approvals that are required to execute the deal.
Yeah, a lot of it is time. So as Blake says, some of the hard work might be done at that point in terms of negotiations, but just keeping the process moving and getting all the right people in the room at the right time or on the right calls and making sure the information's flowing, it does take a lot of time on the advisor's part, and even on the closing day and pre and post closing, there's always stuff that needs to be wrapped up properly, and supporting and facilitating that does take a considerable amount of time. But on that point, then Blake, we talk about the involvement of the M&A advisor and how long that takes. What about from the legal perspective? Post-close. So is it just a case from your perspective, certainly from me as an M&A advisor, post-close, people are integrating businesses, they're onboarding the teams, and you largely step back and you've spoken to people every day for months and months, and then very quickly you're not really talking to them anymore. How is it from a legal perspective? Is there a lot of stuff to do post-close?
Yeah, post-closing, it depends on the deal structure. Again, in many private deals, there's a post-closing indemnity period. So we remain involved in facilitating the analysis there with indemnity claims and any contractual validity to those claims or invalidity to those claims, dispute resolution, and then hopefully avoiding litigation. But obviously that's where we come in as well. We also remain involved in post-closing integration, as you touched on, and of the two companies, which centers around the key issues that you described: employee matters, compensation integration, and third-party contract integration as well between the two parties. And then in the event that the target company
that sounds like upselling from a legal perspective, post-close and generating all this work afterwards. Let's talk about that that thorny issue of fees and fee structures, and what should a seller expect then from a legal fee structure, and you talk about them being involved afterwards in other areas. What should they expect from the legal as it comes to costs?
Yeah, on the sell side, similar to the financial advisory fee structures as you're familiar with, we typically work on a fixed fee deal structure, and we continue to bill on our hourly basis throughout the course of the deal. But then we credit any accrued fees that we've billed along the way to the fixed success fee.
Okay, yeah. So, and I've seen it work both ways. That is a very common way of doing things. Obviously, from the M&A advisory, people talk about fees based on the value of the deal. People do like to have fixed numbers, so we will work on a fixed fee basis as well. Largely, largely around the size of the deal. But I think what the question that always comes up is, if it's a smaller deal, can we drastically reduce the fees because it's a much smaller deal? And I think to a degree, everybody wants to do that and tries to do that, but certainly from the advisory perspective and the M&A side, sometimes the level of work is just as much, if not more, on some of the smaller deals, and there's actually a lot more to do. So the level of work isn't always dependent on the size of the deal, and certainly I find myself having to explain that from time to time. I'm sure it's the same from the legal perspective.
Yeah, absolutely. I mean, for both of us, I think we have similar, we have relatively similar fee structures. The key piece on the sell side is that people
Yours
should
will
know
obviously
is
be
that,
much bigger than mine.
what's that?
Yours will obviously be much bigger than mine.
It's the reverse. The key piece is that for the most part, the key advisors, legal and financial advisory, are success-based fees. So,
Yep.
we get expense reimbursements on your end, and we're willing to work with clients to manage particular desires to defer fees in the M&A context until closing. So that's the key piece to keep in mind.
Yeah, and I think it's important that to talk about success is really what drives us, and that's where the fees will come in. There may well be retainer fees, but certainly the retainer fees are not why advisors are working, not in the legal and not in the M&A. If anything, the retainer fees are there to kind of focus the sellers more than anything else, and to cover the early stage work that's being done. But absolutely, the success fees is what everyone's working to ultimately.
Yep, absolutely. So why don't we shift into your views on a list of materials that people should think about getting prepared in connection with exploring the possibility of a deal?
Yeah, and I'll refer to a couple of slides here that I've prepared, but there's some information that every deal is going to need to have, pretty much from the get go. So before you can start your outreach, you want to create some kind of teaser. You want to be able to talk about the business even before you identify who they are. You need to be able to talk about the size of the business, the metrics of the business from a financial perspective. So looking at the list that I've prepared here, and the bold items are the ones that you definitely need more so than the others. But we're going to put together a teaser, an IM. You're going to want, the recent financial accounts going back as many years as reasonable, depending on the business. How much of, if it's a software business, how much of it is recurring, how much of it is licensed, how much of it is services. Basically, the things that will identify how this business generates income is really, really key. Bookings are asked for by some people earlier on than others, but always good to have. Your current year-to-date financial metrics, how the business is performing to your expectations. What does the outlook look like for the rest of the year? So those are important. Customer retention is important, from a development perspective, backlog and commitment and all those kind of things. And then, given that we're talking about tech businesses, tech stacks and what does the tech actually look like is quite key. So all of that is quite important to have early on in the outreach process at a high level, although you won't necessarily want to share it in too much detail or identify people and specifics. But that definitely is stuff that you'll want to have early on. And then as we start to introduce potential buyers to the sellers, at that point, they already have a fair amount of knowledge about the business, but certainly in preparing for that original call or being introduced or introducing the buyers and sellers. So, company history, background, much broader view of where you sit in the market and competition, and the team and the structure and the people you're working with. All of that information is good to have in the initial call. Again, you might not be under NDA in some of those calls. Sometimes you will, sometimes you won't. So knowing what to share is quite key. But certainly, again, I'll refer to the screen in the list here, but a bit more about the commercial aspects of the business and what the business does is very, very key. And then moving forwards beyond that, once you want to get to an offer stage, you've talked about the business, the sellers and the buyers have met in a couple of calls or meetings. They may well ask for more detailed information before an offer. That will certainly be under NDA, and you need to be prepared to share a bit more detail. Again, you won't be sharing customer names necessarily, you won't be sharing prospect names, but certainly digging a bit deeper into that kind of information. I refer to the list again, but being prepared to be able to share that kind of information is something you should prepare for at an earlier stage. So the last thing you want to do, whether it's at the initial outreach stage or just a day before a call with a prospective buyer, or even just before you're trying to get an offer together, the last thing you want to have is massive delays in trying to put the information together. So knowing what's required along the way is very, very important. And I think looking at the calls and the interaction between the seller and the buyer particularly, I think one of the things it's always worth mentioning is, yes, the buyer is the one buying and the seller is the one selling. But certainly, if there's going to be an interest in the seller remaining long term, if there's going to be earnouts, if there's going to be things post sale that are really important, the buyer, the seller needs to know who the buyer is. They need to be comfortable with the buyer. There's no reason why they shouldn't ask potentially difficult questions of the buyer as well. What's your strategic rationale? What would you do with the business? What's going to look like afterwards? All of those questions are things that the seller should have and should be prepared to ask. And it should be a two-way conversation. So again, I refer to the lists, but there's definitely all the information that you're going to be asked for is definitely something you should be collating well in advance.
Yeah, particularly too, I think your final point on getting information about the buyer and doing what we call reverse due diligence, but to the extent that we're looking at a transaction that is based on stock consideration, that adds a whole other two-way street on due diligence and making sure that we have a firm sense of the key aspects of the buyer's business as well. So one question for you on the financials, given this current market, and the standard tech valuation of high multiples, do you have any advice for potential sellers as they think about maybe pivoting the business right now and kind of creating a more substantial sense of historical financials around revenues and recurring revenues, and just making sure that those metrics are a little bit more solid? Because I think that my sense, and I'd also like your opinion on this as well, is that buyers are looking for a little bit more of a tested a tested business that's really generating cash and revenue.
Yeah, and that is correct. And there's always things that buyers like, and high recurring revenues and higher margins. Those are things that they look for. But at the same time, especially if you're enterprise software or things like that, there's an understanding that services come into it, and as you build up a business or build up products or build up tech, people do use services as a way to generate a cash to inject into their business and to build out product. So never shy away from your services revenue or revenue that isn't recurring, but absolutely what you should be prepared to do is to tell the story. So the numbers are what the numbers are, and absolutely people like high recurring businesses, and they like an element of services, and they like margins and all those kind of things. But ultimately, what they really want to know is that there's a decent business here that can support its client base, that has a rationale for doing what they're doing. And if we're dealing with an earlier stage business, a scale up business, perhaps, then it's fine to be able to say, look, we're moving in the right direction on recurring revenues and some of those things, and we're not quite where we'd like to be, but actually we're well aware of it, and the business is positioned to be able to get there. So nobody's expecting it necessarily to be there on day one, but at least being able to explain why it isn't there, or how it's going to get there, or what the rationale is for the business, together with how you're going to get there with the business plan. That's what people want to see. And yeah, context is everything. I think one thing I hear a lot is, especially from the earlier stage businesses or the scale ups, is, yes, we don't have massive scale, but it's all about the product, and somebody's going to buy us for strategic value of the product. Absolutely. But bear in mind that we're not talking about venture. If we're talking M&A, we're talking about strategic buyers or potentially institutional buyers. Absolutely, they might be buying it for the product, but they are not going to give you valuations based on, the risk that a VC is prepared to take. So however much it's about the product and about strategic value, the metrics and the previous performance does come into it. And no PE firm or no industry large software company is gonna take a VC tack on it and say, oh, we think it could be worth this great massive multiple because of the future potential. They don't absorb that kind of risk. They're not VCs, and they don't think like VCs. So yes, they'll buy a product for strategic value, and they may well pay a premium for that strategic value. But absolutely, the numbers, performance, and current year forecasts and growth, obviously, is really important to them.
Yeah, and key pieces to start preparing those historical financials now, because sometimes that can take some time with your internal finance team and your auditors, though not often the case there with private deals necessarily.
Yeah, but I think in that sense, there's an expectation of what you should have, and if you're a decent management team, you should know some of this stuff and have some of this stuff already. So the last thing a buyer wants to see is that you're scrambling around trying to piece together information that you should really have. So yeah, they'll have detailed questions that you might not have at your fingertips, and it's fine to be able to go back and get those. But key things like financials and some of that kind of stuff, you should be able to snap your fingers and have it ready. So it's really important that that you can articulate it, you can talk to those numbers as well as actually produce them.
Absolutely. Well, I think we've covered it, Ben. So I don't know if you have anything else, but we are always available for any participants to contact either me or Ben, and we look forward to continued activity in the industry.
Absolutely. So, we both make ourselves available to have chats with people, just understand your options or your position, or just provide some guidance. But we look forward to hopefully serving you and working with the real estate tech industry to continue the good run that it's having.
Definitely. Well, thanks, Ben.
Thanks, Blake. Always good to see you. Always good to talk to you, and look forward to speaking to you.
Likewise.